Hello and welcome to the video for Module 4. In this video, we're going to be discussing 3 applications for trading put options, whether they're long or short put options, and then we'll discuss the challenges and liabilities inherent to these strategies. Before we get going, I would say once again, if you need understanding on how the price of the put option moves with price and time, please consult the text for Module 4 as well as Module 2, which goes over the pricing of options and how it moves with price, time, and volatility. In this Module 4 video, we're going to briefly discuss the 3 different applications that we can use put options for. And the subsequent modules of this course are going to focus more on the income applications. So don't get too frustrated if we don't go through the entire set of rules for the income trade for this. We'll get to that shortly. Let's start off by covering long put options for gain, which is really what most people associate put options with, is as insurance or making money to the downside. So we know that long put options gain value as the price of the underlying asset goes lower. So this is why they're a short delta instrument. I'd like to start introducing that terminology to you because this is how professional option traders speak. They talk in terms of delta and theta and gamma, things like that. And rather than me continuing to talk about you being a puppeteer of option values, I'd rather start to use the option Greeks in a slight manner, right? So just enough to get you understanding why the dynamics change. They're also highly sensitive to changes in implied volatility. They climb in value if the implied volatility rises. So this is where they share the same values as the call options. However, the call options have a huge disadvantage compared to the puts with this, as we will see in a minute. What we're always trying to do when we trade options is to stack the probabilities in our favor, which can create massively profitable trades. So we don't want to enter a trade if it's just, hey, this puts time value decay into our favor. We can certainly do that, but eventually what will happen from that is that we'll get into a risk condition if we do that. Where we get into a better situation is where we stack the probabilities on top of each other. If, say, for instance, we multiply the edge of our trade with not only maybe time value decay, but also in the manner that the trade responds to changes in implied volatility and as well as the way that the trade responds to changes in price. This is where we're going to get into really, really good conditions for setting up option trades. So can you think of a scenario where it would create more than one edge with a long put? There is one time where we see both of these edges come together and really multiply the gains that you can make from a long put option. And that is going to be the big, ugly downside move. That's not a technical term, but it's more just descriptive. The big, ugly downside move. This is where we have a couple of things going on. So first of all, obviously we have the price going down. That makes sense. The price is going down and it's going down in a very rapid fashion. This is not just drifting down. This is really selling off and selling off very quickly in all 3 of these. And the reason for this is that because this is in a bear market, which is what we're going to have, right? If we're in a bear market, you're going to see more movement, more violent movement to the downside than we're going to see violent rallies. So obviously with a long put option, first of all, we are short delta. So I'll just put SD for short delta. That means that the price of the option or the value of the option actually goes up if the price goes down, right? So that's not a big surprise. Now, what is a big surprise to people is that options, long options, are what are called long vega. And what that means is that as the implied volatility goes up, so goes the value of the option. So think about this for a second. If implied volatility is sitting here at a fairly low level, because it normally is on a rally back up, so everybody's complacent, everybody's thinking, oh, nice rally, everything is going to get much, much better going forward in the future. So people get complacent from there. So you'll see if this was a relatively high value, it'll go towards a relatively low value on the rally. Now, as soon as the price starts selling off, what you'll see is implied volatility peaking and will actually peak as it gets down to the bottom here. And so not only is that put option gaining value from the price going lower, check, but it's also gaining value as the implied volatility starts to rise. Okay, so this is where we have two of these components actually working in harmony with each other, and it can be very, very dramatic. So first of all, again, number one, short delta position. Number two is we have LV, which is long Vega, which means that it adds value to the option as the implied volatility starts to move. So this is one of the more dramatic applications of how we can compound and multiply our edges in options if we understand all these elements to the option above and beyond what the typical retail trader is going to do. So again, to summarize, it's a situation where the price of the put option literally explodes in value due to the synchronized forces of price falling and implied volatility jumping higher. But you cannot chase this trade lower. Here's the problem with this. It's going to be difficult. You're going to miss the entries on here. You have to be in it to win it. And that's going to force you to think like a professional. It's going to force you to think like a contrarian while everybody else is high-fiving each other and getting complacent while the price is going up like that during a bear market. You have to be thinking opposite to the crowd, and you have to be adding long puts during a scenario like this. You have to be in it already to win it. If you wait for the move lower to begin, you're too late. Do not enter. And this is why. If you enter too late, then you're entering at a much higher implied volatility. So first of all, you're paying much more for that option, and the price has already fallen probably halfway towards the eventual move for it. So you're getting much less edge to it. You'll be lucky to get any positive value out of the trade. So not only will you pay a lot more for it, but you'll be lucky to walk away at the other end of that trade with any kind of gain from it at the end of it. I would only consider placing this trade while you're in a corrective market condition, not a primary bull. So what you don't want to be doing is while the market's ripping higher like this, try timing one of the pullbacks. That is going to be an exercise in frustration. So don't try to be doing something like this where you're trying to make money on the downside. I would more focus. We'll actually show you the other side of this strategy where you can take advantage of these pullbacks in a bullish trade, which is our third application here today. But don't try to play these counter trend. Only play these if the market's in a primary bear and things are happening like this. So this is where you're going to be entering them. You're going to be entering as the prices is ripping higher in a bear market rally, and then we'll talk about how to set up the exit for these. So this is one directional trade where the various elements of options can actually make it much more profitable than just trading short futures. This is the one application where I will say where futures do not have an edge over the options in this case. Normally, futures are a much better directional trade, but the compounding factor of how Delta and Vega work together in this means that you should be looking to trade options if we're in a bear market like this. So what kind of a setup are we going to make for this? Bear market or corrective market only, looking for upside exhaustion, buying climax at resistance. How much time should you buy of the option? Remember, when we have options, we have to pick the time based on the expiration date. So how much time should you buy? At least twice as much time as you think to make the move that you're forecasting. And that was because in the last 30 days, that option really does eat value from time value decay. What strike price do we pick? Out of the money options actually might be a good choice in this case. They are going to exhibit the wildest swings in profit and loss should the move materialize. So keep that in mind that you're going to see this thing flying all over the place. So it helps to have your exits defined ahead of time. I will typically select an out-of-the-money put option that I believe is at support. Now, obviously, this is hugely subjective, but it will help you create some kind of a target for this. You never know how far or how fast these things are going to fall when they do start to fall, but you might get a sense of what is the average swing length when it does fall. And that will give you some sense of where the target might be after one of these swings. So if the price is up here when I'm entering, I should be able to determine based on how long I typically think that the move will take. So we're going to have some length of time estimate for this. And again, I'm going to add double onto that. So if I'm entering here, if I'm lucky enough to get up at the top, I'm going to enter double the amount of time on here for the position. So I'm going to say this is T plus, T times 2 for that move. So that's the actual series that I'm going to pick. And then for the actual strike price, we're going to be able to determine, okay, so maybe it's going to start here, let's say 12,000, and I'm going to target maybe 9,000 for this move. And what you'll find is that the gains from this, here's another thing, which is probably beyond the scope of this program, but there's this issue called gamma where the delta will actually accelerate. So if I'm setting up this option way out of the money, we already showed in the option pricing and also in some of the text up to this point that the deltas are very low of these out of the money options. Well, that's what you're paying for because you're getting those cheap options. So they don't move all that quickly up here. You may be disappointed by how little that the option moves up there. But what happens is the price will absolutely skyrocket as it gets around that target level that you pick. So if you're able to do everything correctly for this, it will be an outstanding gain that you'll want to do again and again. Just understand that no matter what you do, you'll never catch the very top, nor will you catch the very bottom. You'll be disappointed, but over time what'll happen is you'll be okay just catching the meat in the middle of any trend. I will pull off most of the position size when I see the price hit my support target. That's good enough. I don't care if it doubles from there to the downside. As long as I'm trading to my plan, I'm happy with that. I'll try to save at least a small portion of the position to act as a runner. So maybe if you're able to trade in threes, it may not be necessarily that bad. Again, if you're trading 3 contracts, that's okay. You're able to do that even if you have a small account because the premium on those options that are way out of the money may be relatively cheap. It may be something like $20 or $30 per contract, which just about anybody could use a large position size there of in threes. So maybe as the price comes down to my target, I'll take off 2 of the contracts and I'll save the final runner for whatever I can get if it does extend at least a little bit further. If the price starts to make higher highs and higher lows, then I'm out. Keep in mind, guys, even though this sounds awesome, this is a very low probability but high reward home run setup that will require you to think outside the box and beyond today's public narrative. You will miss the first few times that you identify something like this. You'll say, oh, I would have or should have or could have entered right there. It will not feel right to enter, which is going to be the optimal entering point. Our next application for long puts is going to be for asset protection. This is more of a niche application for those with large enough portfolio that they really do require active risk management. So in other words, if you've got multiple Bitcoin out there, this may be a fairly large position, and maybe someday it could be a very large position, even if you just have a handful of Bitcoin. A long Bitcoin portfolio will be long delta, right? As it will increase in value with the next point move higher. So long puts are short delta, which gain value in the next point move lower with the price. Using long puts will help to somewhat hedge any downside moves in a portfolio by gaining value if the price moves down. And it's just like insurance, right? Think of it as insurance. This is what long puts really are. It is not as easy as it sounds. It sounds really simple to do, but then once you start looking at the actual costs for doing this, it can really add up. And it also doesn't help if you have more than one asset too. You don't really know how many to get. In the equity markets, there's a lot better tools. There's weighting for everything, so you can kind of beta weight everything towards the S&P 500. and be able to come up with one number that you can use of an instrument to be able to hedge your downside, whether or not you need a hedge against volatility or price or a combination of those. Until we do get those tools, the best advice that I can give you for right now is when the price is rising in a parabolic manner and the premium is cheap, this is where you should consider buying some puts, because nobody else will be buying puts at that point. They're going to be super cheap. The implied volatility is going to be down in the gutter. So you should be able to buy puts that are a fair amount of money for very, very little cost. And again, nobody is going to be thinking about doing this at that time except for you. And that's okay, because that's how you have to start thinking to survive in the market. You have to think opposite of the crowd. So as crypto grows up in the near future, analysis tools will improve to be able to more methodically protect your crypto portfolio. So look forward to that, but at least know now that you can start to hedge off a large portfolio. Number 3 is our last application for puts, and it's going to be trading short puts for income. And of course, we're going to expand on this further in the program. This, of course, is a bullish trade meant to be used to earn income while increasing your supply of Bitcoin. As soon as you enter the trade, you're going to receive a credit in Bitcoin, which represents 100% of the potential profits available on the trade. So as soon as you get paid, that's the most that you're going to earn in terms of the profits from that short put trade. So a short put trade is a high probability, low return trade. You're not going to get rich on just one short put trade. You're going to receive that premium from the trade, and that's as much as you're going to get on it. So this can't be taken away from you. So nobody's going to come into your account and take it away from you. However, you can certainly lose more on the trade that you earned initially. This is why risk management is important on any short option position. They can take away from you during the process of settlement. Just like long puts, there's a condition that occurs that dramatically increases the probability of success with this trade. The trade characteristics are long delta. Remember, long delta means that as the price goes higher, the value of these options, the value of the trade increases. So it's a long delta trade. Short time decay, meaning that the longer that we have the time in place of this position, the value of that option is going to decay to 0. And since we sold it, that's what we want it to do. You want it to decay to 0. And lastly, we have short implied volatility. What this means is that we want to be selling implied volatility while it's up here and then drops after we enter the trade. Okay, so what can we do to create a position that's got all of these elements to it and can really multiply the potential success of the trade? So the best scenario for short puts is going to be a pullback. Think about this for a second. So if we get a nice sharp pullback here, what's going to happen to implied volatility on that pullback? It's going to increase quite a bit, isn't it? It's going to get scary, right? It gets scary anytime that people are scared. This is when implied volatility is going to rise. Implied volatility generally comes out or drops like a stone if the price is rallying, because this represents certainty, this represents complacency, this represents harmonious conditions that you don't need as much risk premium for. This is why risk premium always jumps on the shore after a hurricane has already been by, but people are very complacent before that point. So think about this. We're looking for a spike in implied volatility, which we're going to get. So as the price pulls down, we're going to spike implied volatility. So that's, let's call that first here, is that we have IV spiking, and that's good. So we like that. Second, we have time value. We've sold an option, and it's going to have a specific expiration date to it. So it's only got a limited time from when we entered the trade. So let's put that in there, that T that we're going to sell the option at. And during this time, the option value is going to decay to 0. So that's working for us as well too. So we have time is in our favor. And then lastly, we have the delta And the delta in this case is delta positive, so we want the price to be moving higher. So anytime we can get a pullback, which reverts to the main trend again, pullbacks reverting to the main trend, pullbacks reverting to the main trend, pullbacks reverting to the main trend again, we've got all three of these working for us on the trade. A bounce from a pullback will create an almost immediately profitable trade as the implied volatility just crushes out of that and the long delta trade starts to work to the upside. So this option will start to melt immediately, not including even the time value element of it. The whole next module will be dedicated to the setup and execution of this trade setup. So we're going to be a little thin on details here for this in Module 4. Module 5, we're going to go much more into the detail and setup of this specific trade, this third application of put options. So we'll see you there in Module 5.